Coming up on today's episode.
And the other reason I think it's really dangerous is if you buy for growth, which we could do for every single customer, like straight in to get the maximum growth we possibly could in any part of Australia based on their budget expectations or budget abilities, then the risk is that you're sacrificing the asset, the quality of it. You're sacrificing future growth. So I could show you 20% growth today, but what if it does zero for the next 10 years? It looked great in my Instagram post, and I'm seeing a lot of these, you can look at the quality of some of these properties that are being bought, and they're like, it's up 20% in the first 18 months, but it's a one URSAD. So it's got, that market is cooked. It's got no ability for the local area to continue to pay those high prices because it's just unaffordable locally.
Yeah, it's like, so there's no point.
Yeah, so it's buyers agents that are pumping up those markets short term, and then they're bailing out and buying somewhere else tomorrow. So, it's the client or the customer that gets, left with the bag there, that they've overpaid for an asset. It's performed well in the first 2 years, and then it's probably a long-term hold where it's going to underperform.
Wow. Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Jo Agresta, and it's time to take control of your property journey together. Welcome back, everyone, to the No BS Real Estate Podcast, your listening how-to guide to the Aussie finance and real estate market. I'm your host, Jo Agresta. Now, today's episode is for all the buyers out there obsessing over where to buy, what's going to boom, and what suburb will make or break your portfolio. Everyone talks about hotspots, the places that are hyped, they're oversubscribed and fueled by FOMO. But while most investors are rushing in at the peak or returning to that market and trying to find the gold within it, we've got our returning guest, Scott Aggett, and he's going to talk to us today about looking elsewhere and what other signs of life you can look for. So Scott and his clients are focusing on green shoots, those early stage suburbs starting to show signs of life and of growth before they hit the headlines. And in this episode, what you're going to learn is what green shoots actually are and how they differ from hotspots, what data Scott uses to identify them, how to negotiate better deals in those markets, and why outcome stacking is the smartest way to maximize your returns. So if you're someone who's tired of missing out or buying at the wrong time, this is the strategy episode you need. Now, if you missed our first episode with Scott, do yourself a favour and check that out. It's actually one of our most popular episodes. He talks all about negotiation. The details are on the screen and in the show notes. He's the expert negotiator behind scottaggett.com.au, and that episode was a masterclass in negotiation for property buyers. So without further ado, Scott, welcome back to the show.
Thanks, Jo. Thanks for having me back.
We talked so much in the last episode that I was like, shit, we're running out of time. We need to have you back. So I was so glad when you said, hey, it would be a good episode talking about green shoots instead of hotspots. So I'm really keen to get into it.
Nice one. Let's go.
All right, done. So I think best place to start is you talked before the episode, we talked about green shoots, right? And I really loved this concept of not going into the hotspots because the media talks about, all the suburbs that are booming. I think if you're anyone that's in the market at the moment, you've heard Bendigo, you've heard Cranbourne East, you've heard Far North Queensland, but you're talking about, hey, they're the hotspots and where everyone's buying. How do we know, what is the definition of green shoots? What do you mean by that?
Well, we're trying to find markets that are going from cool to warm. They're already showing signs of growth right now, and they're going to be tomorrow's hotspots. So it's about using data to identify what suburbs are starting to show those early green shoot signs.
And I think that's an awesome concept. This is why this episode, is so important, because how is that different to the most common way that investors will approach this? So, you've got the hot suburbs. People always rush to them. What's kind of your different approach to this?
Yeah, it's really important to differentiate those two different strategies. So if you're going to, say, extract equity and you want to focus on that with short-term growth, you might be looking to invest in those hotspot markets that have already shown signs of, say, 10% plus growth in the last 12 months. That's a lead indicator of what it's likely to do in the next 12 months if the other metrics are aligned. The green shoot method is to try and find those areas that are going to be the future markets that are going to go 5%, 10% and beyond.
So I guess with green shoots, how is that different to the way most investors are currently approaching buying a property, when they're chasing those hot markets or those hot suburbs?
I think herd mentality is the easiest way to establish those markets and the problems with that. And what happens there is that you're competing against a lot of buyers and buyers agents. You're competing against local owner-occupiers that are trying to get into that marketplace. So there's a lack of stock, typically, that's driving that price growth. There's a lot of buyer competition, as we said. And then you're risking paying a record price. You have to pay the top. So if the music stops, you're potentially held with, the highest price in that suburb in this growth cycle. So do you want to compete in that marketplace? Do you need that sugar hit of capital growth right now? Are you going to be compromising potentially on the asset you've got? Are you limiting your choices in terms of the properties that you've got to choose from? Because there's not going to be many motivated sellers that are trading in that marketplace. So the green shoots is the opposite of that. For us, it's getting to these markets at a much earlier stage using the data. These markets are already on the rise, so we've got confidence they're moving in the right directions. The metrics are right. And when we buy in those markets, we find that we've got more choice, we've got more motivated sellers, we've got less buyer competition, and they create me more favourable negotiation outcomes. And as you know, my passion is around buying these assets, not just in the right location or the right asset, but buying it at the right price.
Yeah, spot on. And I love that because you're right. Like everyone's complaining at the moment. Like I say everyone, but anyone who's trying to get into these markets that are considered hot, they are facing exactly what you just talked about. It's being outpriced. It's the FOMO about it and the competition, like that they have to pay a premium.
Absolutely.
Basically. And they will pay a premium because media and other sources are saying you've got to buy there and you've got to buy now.
Yep.
So everyone starts running like it's on fire. And then, like, what do you think the reality is of that? Like, if I do pay a premium, like, I kind of know where I'm going with this. But if I go into these hot markets, I do pay that premium because I don't want to miss out. You're probably not going to see the same amount of growth, I would say, like, down the track because you've just extended your, like, how much you're going to pay for it, right?
Yeah.
So with green shoots, I guess what kind of, like, delving into the signs, how do you kind of, what are those, like, metrics or signs that you do look for?
So going into those markets, the risk is that you're going to mistime the property clock, right? So you're buying in peak market conditions or even a decrease in growth cycle. And you can make money in a decrease in growth cycle, but the likelihood of those suburbs that have performed at that high growth in the short term, the years before that, likely to plateau next, right? And if you're buying in the wrong suburbs that have got volatility and have shown that long term, that when you hit those troughs in those market cycles, it's potentially going to be into negative territory. Yeah. So it's about de-risking that process as well and getting into these markets that have got more consistent growth earlier into that growth cycle that you can benefit for that full run that it's got ahead, that big runway ahead. So we just find that's a safer way for our clients to invest. It's typically a long-term mentality though versus that short-term sugar hit. So it depends if you're a buyer that wants to extract that equity that's aggressively in the accumulation stage, or if you're looking for a safer way to invest long term where the fundamentals align. So in terms of what metrics we look for, what would define a green shoot market for me is a market that previously has performed without a market return. So if we're looking in a particular suburb that we're buying in Melbourne at the moment, for example, or one of the suburbs, it's done over 125% growth over the last 10 years. So it's double the Australian median house price average. However, in the last 3 years, it's been less than 15% growth. So you can see that when the wind is behind it, that market's got the capability of really riding some big growth numbers. But it's stalled, it's seen limited growth, and now month on month, it's growing at a faster pace. So we can see that that's starting to show early signs of green shoots, and that's a market that we're confident has got the right socioeconomic score. So it's got the right demographic there that it can afford for those prices to continue to rise and also for those rent prices to potentially increase further. We've got days on market that's shortening, so there's buyers that are taking decisive action and properties that are turning over. So there's volume there and there's action. So there's something that we can measure there in terms of the stock and how fast it's moving. And then we're looking at long-term and short-term inventory and stock on market pressures as well. So we want to see a big downward slope really in terms of the graphs, and we're looking at the modelling of how much choice there is for buyers and how long it's going to take to mop up all that inventory in terms of months. So when we get all of those things right, the biggest thing that has to match that is years to own. It's got to be affordable. So we're looking for markets that are really affordable, that match up with that higher socioeconomic data. And when you get all of those things right, it's prime for growth, and we're investing in locations that are already, as I say, growing. So there's no risk that this is a strategy that you're punting, that it's, when is tomorrow going to come? Tomorrow's already here now. The early signs of it are, and then it's going to continue to blossom.
Well, I really like that it's historical based, right? Because that's the data you go by. So you kind of look back in time and look at the trends, like what is actually performing versus what's not really showing those signs. If you go on the other side of the coin, is there like a particular metric that kind of indicates to you that it's probably not going to work out? Because some people find it risky. Like they go, this sounds great, but is it risky to not buy in the hotspot? And I'm like, well, I think it's riskier to buy in the hotspot at the moment. But in this early stage, so what is that kind of key indicator? Is there one key indicator or is it all of them in combination that have to kind of make this puzzle work?
Yeah, good question. I think, first of all, if we peel it back a layer, it's about strategy for you. So it's a bespoke strategy that is your specific needs. And you might be adding to an existing portfolio. You might be building your foundation property that you want to do a lot of heavy lifting for you to get you to property number 2 in due course. So it's finding the right fit for what you specifically need. Some people might prefer to trade off that long-term growth for that short-term sugar hit for them to be enable them to get to that property number 2 faster. But in terms of the metrics, I think it's actually the safest way to go in terms of this because you're looking at markets that can grow. Historically, they've grown really well. And then all of those lead indicators are going in the right direction. So if you look at it almost from a dashboard perspective, you've got green tick, green tick, green tick, green tick, green tick. And that just for me is like, okay, well then that's lit up, ready for us to buy into that marketplace. The reason I like getting into those markets as well is, you're reducing that buyer competition as well. And then that allows us to get very specific about where we're buying, even within those suburbs as well. You lose that opportunity when you're buying into hotspots because let's say hypothetically you're buying in Kerwin right now, 30% growth in the last 12 months. You want to buy a 3 to 4 bedroom house. You are literally going to buy the next one that comes up that ticks your land size and the look and feel and the floor plan and the right rental yield inside your budget. You are not going to have the choice of saying, hey, that's on the wrong residential street. I'd prefer to buy 6 streets to the left. It's just not going to happen like that because stock is so tight. So you're compromising potentially on the asset that you're buying because of those pressures.
I love that because asset is just as important as location. I think we talked about that last time. And, you've just summed that up so nicely. So I feel like, going into this next part is, I guess, buy before the boom, right? To kind of bring this all together, can you give us like a real example of like maybe a client you've had who's like followed that method and they've actually seen some success from it or they've entered at the early stage and what they kind of experienced?
Sure. So, we've been using this same strategy for years, right? And if you follow, you look at a map of Australia and you follow the snail's trail of where we've been buying over the last, say, 7 or 8 years, our clients have followed that map and made millions of dollars. And, a real example of this is a client that we bought in Raceview in Ipswich 2 years ago. Ipswich was already on the move. It was a market that was already growing, but we saw the fundamentals there for that to show, a longer term growth cycle. That is up probably 50% plus in the first 2 years, positively geared asset. You can't do that now, that market's moved. So you could still go into Raceview now and think, okay, it's still showing double-digit growth now. It's a hotspot, but you've missed that lion's share of the growth that's gone before it. We did that same customer in a regional Western Australian city. Again, paid $600,000. 2 years later, it's worth over $1 million. It was positively geared from day dot. It's now well and truly positively geared.
I was like, now it's definitely positively geared.
So we've got lots of examples of this, of getting to those markets at an earlier stage and then being the benefiter of that full run of the growth cycle. And those markets are going to continue to perform for years to come. The alternative of that is clients of mine that would say, okay, great, I need that short-term hit to get into that property number 2, as we said. They might go in and they might get 25, 35% in the first 2 or 3 years, which is fantastic growth and it outperforms the benchmark in Australia. However, those markets then go into a prolonged period of plateau. And a market like that right now might be Emerald in Queensland, for example. High socioeconomic score because there's a lot of mining industry jobs. Affordable, very high yield, seen tremendous growth, probably going to see good growth for the next 2 to 3 years. But beyond that, I've not got a lot of confidence in that market. So that's a buy and sell strategy more so than a buy and hold. So most of my clients are looking at a buy and hold long term. They want to be letting time do the heavy lifting in terms of these assets. They want to make them as vanilla and set and forget as possible. So that's what the vast majority of our clients would want to buy.
Right. So it makes sense now that like when you're talking about strategy, it's like all in, like you said, if you need that sugar hit, that's probably not the right strategy to go about, probably not the right fit. But if it is about that longer term growth and that activation of like that equity and that positively geared, like that client example you just gave, this is green shoots sounds amazing. So I guess, do you ever see these green shoots that you've picked then you're kind of predicting that they're going to become a hotspot in the future. And do you kind of see roughly, like, if you had to put, I'm not going to hold you to this, but like, do you ever see like a rough number of years before it hits that peak where everyone starts buying out all the stock?
It's typically about 6 to 18 months ahead of sort of the big wave of buyer interest that comes. Yeah, because I think that if you're looking for these metrics, they're in plain sight, right? If you just need to know what that dashboard looks like in terms of how you want to structure it, and if you're getting all those green lights, then it's go, go, go. And it doesn't take long before the rest of the sort of buyer agent traffic is after those same locations. And obviously a lot of mum and dad investors are following it as well. So a good example of that is getting into markets like Perth, getting into markets like Townsville or Rockhampton years ago, before that wave, and then those clients have made, you know, hundreds of thousands of dollars, seen huge growth. But you've still got mum and dad investors that are going in there now because they'll ring me and say, hey, what about Perth? I've heard Perth is really hot. Or what about Townsville? It's like, yeah, great. Well, then they are still performing really well. And some of these markets may have legs still for years to come. But most of those are cooked in terms of, and I'm not going to get specific about it. I'm just being very general in nature here.
Yeah,
but
of course.
Most of those markets that have done 150% growth in the last 5 years or 7 years haven't got a huge amount of legs to go because it's unaffordable there. And if you look deeper than that, they haven't got the right demographic there in terms of the socioeconomic scores to be able to afford for that market to continue to go. So you really want both cohorts of investors and owner-occupiers competing in the same market to really fuel price growth. If you lose the owner-occupier market and it's just investors, that's going to run short.
Yeah, because everyone's not paying owner-occupier.
And you haven't got those emotional end users that are paying those prices to get into the right school zone or right in your transport or lifestyle decision-making that's driving those outcomes. And the other issue for me that I've got is if you lose those owner-occupiers, you're then going to really change the dynamic of the suburb. So when you might have bought into a suburb at, say, 35% investor ownership, now all of a sudden it's getting 40, 45% or, growing fast. It's changing the fundamentals of that suburb and the reason why you bought there in the first place.
Yeah, which is awesome to see because that's what makes it dynamic. And then you've got different jobs and like that's where like the job and labour force is important of like who's buying there. Is it younger professionals? Is it full of, mine workers like who are moving into those suburbs? I think Perth was a really good example. Like I remember towards the end of last year, everyone complained about how crap Melbourne was to buy in because we went backwards, right? We were like, I think negative 3.5% in our growth for the property market. And then what happened was all the advocates started talking and going, Melbourne's going to boom next. That's it. You've got to start getting into Melbourne now. And what I'm seeing is the people that were buying in around, like they hung it out through the Christmas period where they pushed through and bought property in December, maybe January. They're seeing a lot of like really quick growth now, that sugar hit you talked about. And it's so interesting because everyone goes, oh, well, if you could tell me where to buy and what the hotspots are, like I always used to say, people go, oh, where do I buy? What do I buy to get the best return? And I'm like, if you've got a crystal ball. But it sounds like green shoots is almost like that crystal ball of you're not necessarily saying it's 100% going to do this, but all the signs are there.
Yeah, I just don't like hype in our industry. I think there's so many people that are predicting these things and guaranteeing that and the rest of it. And it is literally crystal ball stuff, right? So we just fall back on the fundamentals. We're incredibly data focused so that we can back up what we feel is the right strategy for people to de-risk it. And I talk about de-risking a lot because I think that's just so important when you're spending hundreds of thousands of dollars that you take the risk off the table in any way, shape or form that you possibly can, whether it's buying in the right location, whether it's avoiding buying next to a childcare centre or avoiding a bad floor plan. There's many different risks, that are involved in buying property, not just, where you choose to buy that home as well in terms of the suburb.
Oh, 100%.
Yeah. And the other thing is it's all relative. Like, there's been so much hype from buyers agents in how much Melbourne's booming. If you look at Melbourne boom, what's the best suburb done? 13% in the last 12-month growth. Last 12 months in terms of growth. You pair that against, for example, Mandurah, or you put that against Geraldton, or you put that against Kerwin in Townsville, which I mentioned earlier. And a lot of those markets have done 25, 30, 35% growth in the last 12 months alone. So it is all relative, and you need to, I think, have an unbiased approach to this and really fall back on what those key metrics are that drive this suburbs and the performance, and then make a decision as to what the key strategy is for you. And
I think the other part too is a lot of people get hung up on buying in their backyard. It's like I live in Victoria, therefore I will buy in Victoria and probably within 40 kilometres of my house, right?
True.
And the opening up of that mindset of, well, no, you can buy interstate. There's nothing stopping you. And it's like, oh, but if something goes wrong, then I've got to get up to Queensland or got to go down to New South Wales. It's like, well, no, you get the right support around you to manage the property. Like, that's property management. And I think this is where a lot of listeners will go, yeah, you talk a lot about other markets, but like, what if I just wanted to buy near my area? I'm like, but what if your area is not performing and it's not doing what you want it to do? How long are you going to wait to enter that market before you finally get an investment? Whereas if that's your long-term goal, let's say I want to end up with a property here, eventually I just love the area, fine. Your first property is probably not that one.
Yeah.
Your first property is somewhere else, and keep an open mind. It's like you got to strip back all your ideologies, all the things that you know about investing, and go, okay, Scott, just tell me what I need to do. This is my budget. This is my broker. This is my financial planner. Help me.
Well, it's really easy to buy locally because it's something that you can physically go and touch and feel and smell, and people have a lot of comfort with that, which I totally understand. I've got empathy for that. And I think a lot of that mindset is due to watching our parents buy property and just sitting on it for a very long period, and with a rising tide over the last 30 years, absolutely smash it, right? They've all seen huge growth. And the reality is, in Australia, if you buy a decent home in a decent location, it's very likely going to see growth. It's a rising tide in Australia, and we've all done very well. We're a lucky country in that regard. But with data now, we've got the ability to pinpoint those next growth suburbs to get the best of what's available Australia-wide. So I'm in 100% agreement with you that you need to look beyond your own backyard, lean into that data, and you can take an educated punt on where's going to perform at an incredibly high level in the short and medium term. Yeah, spot on. Now, I love this because one of the things like this kind of leads into is, what does that performance runway typically look like for a buyer? Or investor, I should say. Yeah, well, I mean, I think those markets that I would say define as a hotspot typically are in that sweet spot for a few years. It might be 2 years, it might be 4 years, could be less or more. I'm generalizing, but it's typically that sort of 2 to 4 year market where they kill it for a little while, and then typically it plateaus off. Yeah. This green shoot strategy for me is more of a long burn. So we're buying into a market, as I said, that's already performing well. Yep. So in Melbourne, for example, the suburbs that we're buying in that I perceive as green shoot markets based on the data are in the top 10 growth suburbs in the city. So they're already growing at strong rates. It's not a risk there that you're putting your eggs into a basket that may never grow over the next 2 to 5 years. So they're already growing. When we're doing that runway is typically very long, right? So you're seeing that full growth cycle. So if you can imagine a property clock, the start of that growth is 1 minute past 12. We're buying as close as we can between sort of 12 and 1 a.m. where we've got proof that it's growing. It's not a one-off in terms of that, a 1 month of growth. We're seeing consistency for a few months, and it's starting to align, and the metrics all look really good. They're all in the sweet spot for it to continue to grow. Yeah, and then that typically is a really long, healthy runway where you don't have to chop and change. You can hold on to that for dear life and let the rising tide do the lifting. Well, it's like you said, set and forget mentality, which I like. So, and I think boring investing. Yeah, exactly. It's like not the all right, I just made 40 grand on that, just turn it over and then do all this stuff. And I think, we've talked about the data metrics itself, and I want to get a little bit more specific. It was funny, actually, just a quick sidebar, right? So today I was preparing for this episode and I used ChatGPT for a second, and I said, I need to talk about data. This is what I want to talk about. And it said, okay, so you want him to talk nerdy to you. I said, what the hell? Data dorks. Dorks, yeah. So let's do it. Let's get it. So talk nerdy to me. I liked that. What metrics are you looking for, when it comes, if we have to branch it, right? So it's demand, rental strength, so that could be rental yields, supply, demand, obviously, and then affordability and entry points. Is there any other kind of metrics that you need to look at? I'm a big one on volatility as well. So I want to look at markets that have got less volatility. And the reason why I think is probably stems from my experience having done this now for 30 years and being on the agent side of it as well, where I would see so many of my clients sell properties, probably well before they thought they would need to or had planned to. But life gets in the way, right? Like you might have a child, you might need to get married and you need the funds, you might want to upgrade to a bigger house, you might get fired from your work and have financial pressure, whatever that might be that dictates the investment property goes to the grave. Then if you're buying into a market that has got heavy swings up and down and those lows are really low, and by that I mean the volatility takes it into negative growth in each of those troughs, they're markets for me to avoid because you never know when that market is going to be, at a position where the timing's perfect for you to sell. So I think just another way of de-risking it. So I'm looking for markets that have got consistency.
Gotcha. I think that's super important, what you said, that volatility. And the fact that you've got access, like I think the difference is a lot of investors who are probably tuning in are like, oh God, this sounds like a lot for me to do myself. Honestly, it is, right? Because you guys are better off talking to someone like Scott or talking to Scott directly about this strategy, because when you're doing it yourself, you can give it a crack. But if you don't have access to these types of data points, you don't know what you're looking at, it's overwhelming. It's too much.
Yep.
Even for us as advocates, we sometimes, our head spins when we look at this stuff. We're
100%.
like, Jesus, okay, hang on a minute.
And there's so many things that you could use a few key fundamentals in terms of your thinking, and it might be, the supply currently, the demand currently, and how affordable it is, for example. Now, they're three great sort of key areas to focus on, key metrics. But you've got to understand those other layers as well. So there's sort of top tier layers, there's second tier layers of data, and then understand how they correlate together as well. So there's a lot of moving parts with this. Just the platform that we use alone has got, I think, over 130 different filters. And then you've got the ability to weight those outcomes or those filters based on what your risk profile is and what the goal is and the objective of buying that investment property. So there's just so many variables with this. So it is something that we spend a lot of time to invest in education. We live and breathe in that space. And we're, I think practice makes perfect, right? Like you're in there all the time. You're looking for these key outcomes and items that pop up like that. And then you're watching the market to see them play out in real time to give you that confidence to say, great, okay, well, that was a lead indicator. And I saw how that converted into that growth cycle that occurred 2 years later or 3 years later. It's about longevity in the industry.
It's spot on, right? And like 30 years, you've seen so much in 30 years in terms of like, you can't compete with that kind of experience. But even myself, like I've been in the industry, maybe nearly 20 years now, but 30 years on, you've seen GFC, you've seen before GFC, you've seen after, you've seen COVID.
World War II. Oh, no, sorry, not that.
Sorry, Prohibition, panning for gold. Literally, this is panning for gold. This is
exactly
the millennial version of that. So, moving into data, like, you've explained this so well. You've got like a mental checklist that you've kind of gone through of like what you look for, signs of life, and the data layering to it, right? So I really like that volatility trend though, because that's so true. I've seen so many markets do that where I've just consistently, since I've been in real estate, they're always really high or really low.
Yeah.
And I'm like, when do you sell in those markets? Like that is so hard to.
Yeah, it's one of the key reasons why I don't promote a lot of what we buy. Because everything's very specific to the client's needs. It's quite easy to sort of just keep, like a lot of the inexperienced buyers agents that love Instagram marketing will put up, up 14%, up 28% and all the rest of it. Like all of our properties should be up. We're all buying using the right data and looking out for our clients. So it should be a given that everyone's growing and outperforming what the Australian benchmark is. That should just be your benchmark to start with, as everyone should be competing at that level. But I don't post a lot of our properties that we buy because it's all very specific to the client's strategy. So it might be that they buy in an area that's based on a yield need, like they want to buy a high growth asset. They might buy something that they can manufacture equity. So there's so many different variables with this as well that I think you've got to be careful about who you choose and why.
Oh, I think you've nailed it there, because you do see a lot of the Instagram posts that, up 20% or, bought this with already positively geared at 15% plus and all these kinds of things. And it's great, that's fine. That's probably a strategy, but you don't know the strategy behind it. And that's why the episodes like this are so important, because it's like you said, property one might have only seen 5% growth, but that's expected because that was part of the strategy, because they're going to hang on to that for 10
Or they got there at an early stage. So we know it's only going to do 5% growth this year, but we expect it's going to do 12% next year, right? So there's a very specific reason we got to that market beforehand. And the other reason I think it's really dangerous is if you buy for growth, which we could do for every single customer, like straight in to get the maximum growth we possibly could in any part of Australia based on their budget expectations or budget abilities, then the risk is that you're sacrificing the asset, the quality of it. You're sacrificing future growth. So I could show you 20% growth today, but what if it does 0 for the next 10 years? It looked great in my
that's
Instagram post, and I'm seeing a lot of these. You can look at the quality of some of these properties that are being bought, and they're like, yeah, it's up 20% in the first 18 months, but it's a one URSAD. So it's got that market is cooked. It's got no ability for the local area to continue to pay those high prices because it's just unaffordable locally.
Yeah, it's like so no point.
Yeah, so it's buyers agents that are pumping up those markets short term, and then they're bailing out and buying somewhere else tomorrow. So it's the client or the customer that gets left with the bag there, that they've overpaid for an asset. It's performed well in the first 2 years, and then it's probably a long term hold where it's going to underperform.
Wow. No, I think that's spot on. And there's actually there's this story that I want to go through, right, from Reddit, because I like to hunt Reddit and see what everyone's upset about. But I would love your take on this, right? And then we'll get back on track. But for this Reddit segment, look, this guy posted and he said the danger of buying too late, right? Interesting. So he says, this is his story. A mate of mine bought an apartment in Burntree Gully back in 2017. He got FOMO and thought he was getting in before prices shot up. Turns out there were structural issues that needed urgent repairs. Owners copped $75,000 special levy each.
Ouch.
Yep. On top of that, the area barely moved in value over 5 years.
Yep.
He tried to sell in 2022 and still walked away with a loss after everything. Scott, when you hear that, what stands out? Like, what could have been done differently here, and how would your green shoots strategy avoid that trap?
Well, it's possibly they bought into a market that was moving at a pretty good pace but had the fundamentals wrong long term for it to continue like that, as we've just been referencing, right? So it might have covered their total costs and got them out at break even, or maybe just near break even, but it could have been a lot better if they were selling in a market that was still continuing to rise and it was just a safer long-term investment. The other thing is asset choice, right? Like if you're going to buy something that's strata titled, you've got to be prepared for things that are outside of your control. And this is almost, unfortunately, a daily occurrence for me, is that a past or a current customer that bought a property in their past that was the wrong asset, and they're coming to us saying we're in negative equity position, or there's $10,000 or $20,000 or $50,000 worth of special levies just been raised. We can't do that. I've got someone, actually a close friend, that's got a studio apartment in Sydney. They paid about $800,000 for that. They bought that a few years ago. It's been performing okay, but pretty average. They get good rent for it because it's got views of the Harbour Bridge, and that's why they bought it. They thought it was kind of a premium sort of property for them. And this was a young guy in Sydney, but he just got hit with $25,000 special levy that's due now, straight away, in one go. That is the entire rent for the year.
That's devastating.
Yeah, so how do you find $25,000 in after-tax money that you're going to spend on a building that you may never see the upside of that? It might just be waterproofing issues that they're fixing that no one's ever going to pay a premium for. Like, you're not updating the building in any way, shape or form that's going to improve the capital value. Yeah. So it's those types of things that you've got to be super careful on the type of asset that you buy. And obviously the research that they did, who knows, in terms of the quality of the strata in particular, and the building quality, and if there was any history of that, or any red flags that we would have pulled the plug on it, even if we were buying a unit specifically for a client that needed that.
Wow. No, I read that story and I'm like, this is a perfect example of, that FOMO mentality and buying that asset to get into the suburb that's performing at the time. Yep. And then realizing long term that wasn't the right solution necessarily.
Yeah, and that goes back to your point before, I think, about just buying somewhere near you. And I don't know if they were near that location, but we see a lot of that it'll be like, okay, great, I've got hypothetically $500,000 to buy. Well, that gets me a small one-bedroom apartment in Sydney or Melbourne or whatever it might be, where I live or near where I live. And I'm sort of tying up between renting or owning, and they'll go and make that decision, right? Yeah. That's a poor investment, though, compared to what they could have done if they were looking for, a house with a decent portion of land. The land is appreciating, the house on it is depreciating. So if they went and found those growth locations and they bought the right asset, they would alleviate that strata cost risk, and they're buying into a market that's going to continue to perform well. No one's got a crystal ball, though, so really important to say, like, even the data points in the right direction. That is the highest chance that it's going to continue to perform and do its thing, but you just don't know what's coming tomorrow. Past performance is no indicator of future outcomes, as they say.
Well, it's like, no one predicted COVID and the kind of growth that would happen. Everyone thought the real estate industry would shut down because you can't do open for inspections in person and all that kind of stuff. But it had the opposite effect for a lot of markets. It was like, oh shit, everyone's buying because there's nothing to do. Yeah. We're all saving money. Interest rates are really low. It was a really good time. But no one predicted that that's what would happen. Everyone was like, oh no. this is bad for real estate.
Yeah, who would have thought bat stir fry would have got us, hey?
Bat stir.
Yeah.
I don't think I've heard it referred to. Bat stir fry. That's fantastic. And I think let's switch gears a little bit into the negotiation side, right? Because I like what you mentioned here. So in these high markets like that are on the rise now, or they've risen, right? So they're hotspots. You do find that the negotiation is hard because you've got to be first, best price, best and final, because the competition's all there. But in the green shoots market, you mentioned earlier on that you actually have time to strategize and really work the negotiation differently to how you would need to in these hot suburbs that are happening right now. Talk to me a little bit about how do you negotiate in these types of markets?
I'm glad you brought that up. That is a massive point of difference between buying in those two different strategies. And I do a lot of negotiation coaching for other buyers agents and players in the industry. And this is a question that comes up to me all the time. How do I win in a hotspot market? And it's very difficult. You're competing to pay the next record price. Typically, it's blind bidding. It's done really quickly. You potentially have to compromise on building and pest times or finance clauses. There's a lot of different things that you may have to give up on to give yourself an advantage to win at all in a boom market like that. So it's not my preferred way of buying property. The smarter way is to get to these markets that are showing those early signs of green shoots. And as I said, that gives me less buyer competition. It gives me more choice. Typically, it gives me more motivated sellers because they've gone through that 3 to 5 year cycle and it hasn't performed. So those that have bought at the top of that cycle previously have seen little to no growth, and they're the first ones that are selling. So I'm picking those properties off, and I've got more negotiation power, which allows me to turn the screw and buy better. So very often we're buying below bank valuation, and that in these good locations that we believe, and we've got more choice of homes to do it. And so I've got less fear of loss. So if I see a property and I go for it and the price doesn't quite correlate with where I want it to be, I'll walk away because I know I've got other options. You can't do that when you're buying in Townsville right now. You can't do that when Perth was red hot or in Adelaide. So these are the fundamentals that change the game for me and why it's key to use data to get to these markets at an earlier stage.
I think the negotiation, this all goes hand in hand, but just how you've explained it then, it's kind of like what we were able to do years ago, like when I think just after GFC, everything was up for negotiation. Buyers could buy basically with any offer they walked in the door with, but, not so severe as that. But like you said, the sellers are motivated. They're not seeing that house. Like I'm in Cranbourne East, right? And I'm seeing every house on my street. Slowly it happened. It was like one house sold, then the next house sold. And then I've seen 6 properties on my street go up for sale. That's just on my street. But then when I look at the next street, there's another 2. And I'm like, okay. So one seller's seen it. We've got the agent's door knocking going, oh, we've had a really good market. Do you want to sell? And what's scary is the sold stickers are like 2 days in.
Yeah.
They're gone. And I'm like, holy crap, this is what they're talking about, that it's just going. And honestly, owning the property in that kind of area, I'm like, okay, this is an interesting mentality that I would love to break down with you, right? When let's say you're a current homeowner and you start seeing these kind of activities, your immediate thought is, should we be selling? Right? Like, something's happening in our area. But the reality is there are people buying. Why are they buying? That's what my next thought is. I'm like, oh, should we sell? Because my partner even said the same thing. She goes, should we be moving on? And I've gone, there's a reason they're buying here. And I said, so before we do that, we need to understand why they're trying to get in. So because I think they're getting in for a reason.
It's really interesting psychology, isn't it, in terms of this. So going back to my agent days, and put my hat on there, back in that industry, you would see exactly that phenomenon. One would sell, and that you'd know there was I remember there was a stat back in the day as well within the industry that there was like a X percentage chance that there was going to be 2 more properties sell in the same street or within 100 meters of it within X amount of time. And it just happens like that. So they have that confidence to act and go. So there's a few things driving that. I think I addressed one of them just before that, if you're seeing these markets that are showing signs of green shoots, they haven't seen much growth before. So they potentially paid a full price. They've lost confidence that market's going to do anything at all. They bought the wrong home or wrong investment. They don't have the data or the foresight to look ahead as to what's going to, drive change that's coming in that market. And as soon as they have that confidence that there's people here buying it and they can get their money back or close to, they're out the door. So what they've done is they've just missed this next whole growth cycle.
Correct.
Yeah. So it is really interesting. So I think sellers in that position aren't going to do the research. I just don't think they are. Like Australian public, I just don't think they've got access to these tools.
No.
So there's an advantage there for a buyer coming into that they can pick off those markets and they've got more choice. And when you get to that stage where you're in these green shoot markets, I've then got the ability to find a lot more off-market and pre-market as well. Finding those motivated sellers that want to go, or the ones that have pre-committed and bought elsewhere, they don't have the buyer depth or the luxury that they do in a hotspot to sell really quickly for a premium. So they're looking to sell and they're super motivated to do a deal.
Well, that's an interesting point, right? It's off-market, pre-market, which we've talked about, like having access to. But do you find that in these green shoots type of areas that agents are hanging on to these kind of sellers in their back pocket, that they're like, oh, yeah, he wants to sell, but he's not sure, and you're just approaching them going, I have a buyer that would actively buy this property at the right price, and then that's how you're kind of winning those deals, or not necessarily?
Yeah, I think it's easier to leverage the agent, I would say, in the green shoot markets. So I can empower them with a very specific tight buyer brief and then almost get the agents to do the heavy lifting for us to find those assets, because there's not a huge amount of buyer competition for that. So if I say I've got a red hot buyer that'll pay X for 4-bed, over 600 square meters, blah, 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 this part of the suburb, point and shoot the agents and they'll go and source those assets because they know who these motivated sellers are, or these people that are on the fence, don't want to come to the open public to sell, but would sell if they got the right price and had a buyer wheel through the door privately. You're not going to get that in a hotspot market. The agents, they don't even ring you back.
No, they don't.
They don't ring you back. They don't respond to text messages, don't respond to emails because they don't have to. And they should, because they're lazy and they're transactional, and they would get a better outcome for their seller if they actually played off all the moving parts to get the best possible outcome. But they don't do that, and that comes as a detriment to the buyer that's chasing those hotspot locations. You just cannot leverage those agents to help you very much.
No, and then goes back to your point, going into green shoots where the agents are more motivated to get rid of their stock. They're going to play ball with pretty much anyone who comes to the table with a decent offer.
And then what I found by doing this green shoot strategy over many years is that I've built then rapport with those local agents. So when the wave comes through of future interest, which it will behind us because the data's right, I've actually got a working relationship with those people that I've been there for 6 months plus already. So they know, okay, great, Scott and the Green Shoots team buy from us. They're really easy to deal with. They're nice people to work for. They've got genuine buyers. They action what they tell us they want and they do deals, right? So then, when the pressure comes from all these other buyers agents, they don't necessarily want to deal with those people. They're still going back to us to say, hey, we've dealt with you guys before. We know you guys transact. Have you got someone for this one that we've just listed? No. So I get opportunities long term.
And that's like the benefit of, again, going through someone like yourself, like as an advocate with all that experience. You have the contacts, you have the opportunities in front of you, so it's just the advantages are endless.
Yeah, I mean, I flew down 3 weeks ago from the Gold Coast down to Melbourne. I'm here again this week. I spent all day yesterday and I'll do it again tomorrow in these green shoot markets, building rapport with BDMs, with property managers, with principals, so that I create those opportunities for our clients. And they take those meetings. They buy me coffee or whatever because they want to do deals. You go to Townsville, for example, right now, they don't have the time. They're not talking to you. They're already in bed with 500 different buyers agents and they just don't need you. So it's trying to, find those opportunities and make life a little easier.
Yeah, 100%. And I want to kind of, go into it's something that we talked about last time. It's outcome stacking, right? And this is like outcome stacking for compounding wins is, I think, how you put it. What, for our listeners, what is outcome stacking and how does that relate to the green shoots method?
Yeah, it's an important one for myself and our business specifically. So we're really big on this. And it's about understanding the steps of the buying process and then maximizing each step to get a premium outcome. And they compound on top of each other to get an absolute premium outcome. So by that, I mean, we're heavily focused on strategy up front. Yep. So what is the right strategy? We've talked about that today already for your specific needs that are bespoke to you, so we can tailor that to ensure that you hit your property goals. Next for us is understanding suburb selection and having that unbiased approach, working Australia-wide and working with the best people in the industry and the best data to find those opportunities that are going to be the right fit. Now, the goal for me is to end up with the client that's looking with the blinkers on in one suburb, ideally. So we want to narrow that right down, that we're convinced that the data is correct, the product market fit is correct in terms of the asset that we're buying, the yield and everything is there, and there's enough volume in that market that we can say, great, I know I'm buying a 422 on 600 square meters plus, under 700 grand, returning $650 a week or more, hypothetically, so that we can put suburb selection to the side and we just dial in on asset selection. That reduces the time on market for my clients, it reduces the anxiety and stress and gives them a higher confidence to act. So
Yeah.
it's really important that we distill that down to ensure that we've got a high level of confidence in one particular location. Next up from then is agent outreach. So we're using AI tools for property matching, property sourcing, connecting with agents to create opportunities to find things at an earlier stage, reduce that buyer competition and find those motivated sellers. So it's really important that we get that right. Then we focus heavily internally in our team. So due diligence, analysis and negotiation, they're core strengths of ours. In terms of the outcome stacking, we want to track the accuracy of our analysis. We've got an incredibly thorough due diligence checklist, and then we can quantify the amount of money we save our clients in the negotiation. So it is performance driven, this machine. So we want to make sure that we are transparent and that we're adding value to the clients the whole time. Then we move through the transact stage and then we focus on things like tax and depreciation and getting that right. So we work with a tax depreciation expert. We roll all of that up into our fee structure for our clients. And we found that that's taking our clients from A to Z and getting a premium outcome.
That's amazing. I like that process because it's so clear cut for anyone who comes and works with you. Like, I think half the battle is not knowing what to expect or how to go about it. And you just wrapped it up with a bow so nicely just now.
Nice.
And I guess, I wanted to kind of go through like another case study. Do you have like someone who's come to you before with, they've invested, like you said, elsewhere, maybe with someone else, and they've now got this asset. Now they've got an existing kind of portfolio that hasn't performed as expected or something's happened. And then they've kind of given you the shit heap that is their portfolio and said, help me. And then looking at how do you get that person turned around in, your structure, and like if that green shoot is what suits them and what they want to do, how do you kind of turn that around for them with their existing portfolio?
Start with their goals and work backwards and reverse engineer it, right? So what do you actually want to achieve? What does this need to look like? How much time have you got left in terms of this investment timeline or horizon? And once we understand that, it might be holding on to an asset if it's still doing a job, which might be positively geared, even though it's not seeing a huge amount of growth. There's variables of this stuff. But we do a lot of rebalancing portfolios. So I'll get a lot of referrals from mortgage brokers that say, we've got this dog shit asset that the client owns. Can you please run an agent selection process, help them cut that out, that cancer out? And we need to work out how big that cancer is and how much of an impact it's having negatively on what their future plans are and what their goals are. So often it's rebalancing the portfolio, cutting out those bad performers, and then repurposing that capital and focusing on what ideally is a green shoot strategy. But it may end up being a extracting equity strategy first, depending on what the client's circumstances are and short-term goals.
No, that makes sense. And it's kind of like that story that we went through earlier. That's probably a cancer-cutting exercise, you would imagine. Yeah,
and there's just so much of it, unfortunately, that we've had from rogue buyers agents from years before that, bought into whoop, didn't perform, and, they've got to make a key decision. And a lot of people put that off for so many years. They hold on to this asset in, this thin hope that it's going to start performing, and they don't have access to that data. So it's quite a confronting conversation sometimes, and I deliberately press very softly into that because it is a sore point for a lot of people to say, hey, that advice that you did get when you reached out and paid someone for professional fees was actually grossly misleading. It's cost you hundreds of thousands of dollars here. I need to kind of identify and show you how it's cost you money, because now we can rewrite, that and put you on the right path to success.
So sickening.
So it's delicate to do that, and I do it with empathy, of course, with those people. But unfortunately, it's a big part of it because there's a lot of people that are very transactional in the industry. There's a lot of this, house and land or off the plan or apartment spruikers. There's a lot of people that have bought, crappy assets and unfortunately held on to them for too long.
Oh gosh, I feel like I need to have you back for a different episode about new build.
Dog shit assets 2.0.
I love it.
I'm in.
Karina, write it down. No. But it's so true, like dog shit assets. Seriously, I've seen some shit. I'm not going to switch gears into that because I think we'll be here for another 2 hours. But I think we need to have you back to talk about asset selection, that's for sure. Because, it's a fundamental part of, any type of strategy I think that you adopt.
Absolutely, 100%.
Wrong asset can really screw you up. And I wanted to kind of like, I've had such a good time with this episode because I think it's different. It's a different gear to hotspots. Like, we hear hotspots all the time. The media loves telling you what's going to boom, what's going to grow, and how that market's going to pop off, and you have to get in tomorrow. And then that creates everyone running.
Brisbane Olympics.
My favourite one where everyone started running was the airport that's being built near Pakenham.
Oh, yeah. Nice.
Right, so that'd be huge. International airport. I've heard about it for 10 years. Haven't seen one development. Haven't seen one movement.
Yeah. What about the high-speed rail between Sydney, Melbourne and Newcastle and Brisbane?
There's so, and this is it, like infrastructure is another factor as well, right? Yeah. It's, you know, what's happening in the location. I remember my parents, like I was only a teenager, they wanted to buy in Limbrook, and, you know, this is southeast Victoria, and they bought in Limbrook, and it was just interesting because they said, oh, this is great because, you know, you're in high school, you can use the train to get to school. I'm like, but the train station's not open yet and that road doesn't even connect. And they said, no, it's all being in development. It'll be ready in a year. And I've gone, okay, I was only like 15. That opened when I was 25. That road, as well as the train station.
We've got an example of this also in Melbourne, but this happens all the time, everywhere, right? And this is a problem with buying house and land packages that are on the edge of town. If the infrastructure is not there, there's a high risk. So we've got an area that we had looked at previously, and there was talk of, I won't name it, but X shopping centre brand coming in that would be transformational for that suburb. That didn't eventuate. Then smaller, but still brand name shopping centre opening, that hasn't eventuated as well. And I think a lot of this is unfortunately to do with the developers. Like they go in with the shopping centre to promote both these things, and then they just make a view of whether or not they want to come in later when the market conditions may change or the wind might blow in a different direction, and they pull out or double down. And if they pull out, you're stuck in an area that probably hasn't got childcare, doesn't have the school, didn't get the train station, hasn't potentially got the bus stops anywhere near it, whatever. There's a whole heap of different variables of that. And it could be, in your example, 10 years. It could be 15 years. You cannot control it. Then you're sitting there with an asset that no one else really wants to buy and you can't sell, and it's not performing. Yeah,
it's spot on. That's why I thought I'd bring it up, because it's like this infrastructure question. Everyone's trying to buy where there's infrastructure. They look at town planning. It's like, but if you know how town planning works, a lot of it either doesn't eventuate, doesn't go to plan. My favourite one is
save it for Dog Shit 2.0, the next episode. I'm joking.
No, but it's so true. I could keep going. I just enjoy talking to you, Scott. I think our listeners enjoy hearing you. So
thank you.
I want to go, wrap up towards the end now. Like, could you give maybe 2 to 3 anonymized examples of recent deals, like price strategy, terms, et cetera, like that, someone could adopt today? Like, let's say someone's feeling pumped up after this episode and they're like, all right, I'm going to start trying to investigate a green shoot.
Yeah. Okay, cool. So, let's use Melbourne because it's hot on everyone's lips at the moment. So there's locations in Melbourne, and there's one particular location, one suburb, for example. I won't sort of name drop suburbs because people can do their own research in this, because there's multiple depending on what your strategy is. As we said, it's got to be bespoke to your needs. But there's a suburb there that we've been regularly buying under bank valuation, which is really hard to do. We have got typically days on market of about 28 days or less for our clients that sign on. So they're buying reasonably quickly as well, and they've got a choice of homes that they're buying in. We're outperforming the data by buying typically 20 to 30% bigger than the median land size for the asset type, 30% on average above the median yield for the suburb. Yep. So that's where you're buying, potentially with inbuilt equity, and then outperforming the market in terms of the quality of the asset, the size of the asset, and the return of the asset. And that is live in Melbourne right now, of which I've got 8 customers that are buying in that suburb right now. So then that will change. That might not be there tomorrow, right? Or in a month's time, the fundamentals might not look as good as that because the market's moving so fast, and then we'll be off and buying somewhere else. Typically not month by month, but maybe quarter by quarter. The data may change enough that we move locations, and we're not just hell-bent on that one suburb. We've got multiple of those green shoot suburbs like that we're looking at in Melbourne, for example, or other parts of Australia as well.
Yeah, it makes sense.
So it depends on budget, depends on how much, from a cash flow perspective you need. That's a big issue in Melbourne. The yields are really weak. That suburb in particular, our average yield is 4.65% gross. We're spending typically under 700,000 or usually under 650.
Jeez.
And we're buying houses on, north of 300 square metres that are in easy commute of the CBD. So what I'm seeing as an alternative to that is a lot of the buyers agents buying in markets that are performing at less or maybe slightly better month-on-month growth, but weaker ERSAD, so lower socioeconomic locations, double the distance away from the city, and double, triple, 4 times the age of the home, which I think is a capital expenditure risk. So that's a whole other conversation about the type of asset that you buy. But typically my clients are buying modern set and forget type homes because they don't want to keep digging into their pocket to repair
upkeep it.
gutters and roofs and crappy fences and those types of things.
Yeah, we're going to have you back for Dog Shit Properties 101.
I'll bring my laundry list of examples.
All right, can't wait. No, Scott, as always, this was brilliant. Fantastic insights. I think in terms of anyone who's tuning in today, if you want to get in touch with Scott, I highly encourage it. Like, conversation, as I've always said, is free. That doesn't cost you anything to have a chat and see if this is the right strategy for you to adopt. If you've loved this episode, also go back and listen to Scott's original interview where he talks more about what, his journey, how he came into this space and all the wealth of knowledge he has on negotiation strategies. But you can find Scott at scottaggett.com.au. Is that the best place to contact you, Scott?
Yeah, and we're just about to launch Green Shoots Property, which is what we're doing in the background, but I've been deliberately under the radar for the last 6 months or so since the sale of my last business, Hello Haus. So greenshootsproperty.com will launch on October the 1st, and that is where we're heavily focused on the strategies that we've just been breaking down now.
I'm so excited. I didn't know whether to ask you about it yet, put you on the spot, but I'm so wrapped. Congratulations.
Thank you. I'm super excited about it. So there's a landing page or a holding page at the moment. The website's about to go live, but if anyone wants to go there and register or just check in and say good day, reach out.
All right, what's the website that we should go to?
greenshootsproperty.com.
Nice, you heard it here first. No, well, thank you again, Scott, and thank you to our listeners for tuning in as always. We hope this episode was packed with value. And again, if you want to reach out to Scott, details are in the show notes below and also on screen. And we will catch you next time on the No BS Real Estate podcast. Thanks for joining me, Scott, and thanks for tuning in. That's a wrap for this episode of the No BS Real Estate podcast, powered by Abodey AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abodey.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app. Just search Abodey AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abodey.com.au or send us a message. We'd love to hear from you. Thanks for tuning in, and we'll catch you in the next episode.